Welcome back. Just a word on the market. It's very quiet. I mean, not much has changed, to be honest. But there are some stocks that are hitting fresh 52-week highs. So just wanted to bring that to your notice. Polo Tyres is at a fresh 52-week high, post a good set of numbers. So that's building on in terms of both volume as well as price action. Ambuja Cement is at a fresh 52-week high as well. Exide, Ujjivan are all sitting at fresh highs this morning. And then you have a couple of others in the broader markets like an Akzo Nobel. So just keep an eye out on that. But talking about numbers, you have JB Chemicals that reported its earnings. Let's get a quick word in from the management. It was a strong set of Q2 earnings. Revenues rose 36% versus last year. The domestic formulations business saw a near 50% growth, which is well above expectations. And the India revenue business was driven by brand acquisitions. Nikhil Chopra, who's the CEO and whole-time director at JB Chemicals, joins us now to talk about that. Nikhil, thanks a lot for joining in. You know, earlier when we spoke to you in September, you had said that you see a growth of 18 to 20% in the India business for the full year. Do you hold on to that target? Would you want to change it either way?
Thank you, Sonia, and thank you, CNBC team, for inviting me on the show. We continue to hold our guidance in terms of the growth for H2 part of the year. That is high part of the teens. And if you look at what IMS is talking about JB's performance, we continue to be the fastest growing company in top 25. Market is growing at around 3% and we are growing at around 16%. This entire growth is backed up by the work that we have done in our organic business, with our big brands only getting bigger. All our big brands have gained market share, and also a handsome traction in our inorganic assets that we have acquired in last 6 months. That is what is being demonstrated in the growth for India business.
So this inorganic acquisition that you spoke about, do you have any more plans on that front? If yes, what would the war chest be and what can we expect over the next 6 to 12 months?
So we continue to evaluate assets, Sonia, in terms of assets which are available in the market, and at the right time we'll be more than happy to share if there is any opportunity which is coming on the table. But more so, we are looking at inorganic opportunities more in the world of cardiology, nephrology, respiratory, pediatrics, as we have done in the earlier part of acquisitions. That is what I can share at this moment of time.
Hi, Mr. Chopra. Good morning. Should we expect an announcement sometime in the next 6 months?
Niger, what I have shared is in terms of whenever the right time comes, we'll be more than happy to share it with you.
We thought we'll probe you a little bit, in case are you hot on a deal or something, but we'll wait by for that announcement. I wanted to ask you about a smaller part of your business which is growing. That's the CMO business. Could you tell us what is the targeted contribution you're looking at, say in the next few years, say in the next 2-3 years odd? And if you could tell us what is the margin difference as well? Go ahead.
So earlier also, Niger, as I have shared, that two parts of the business, that is, first let me more talk about India business, where today our contribution to overall business is 52%. We would like to take this to 16% short to mid-term in next 2 to 3 years. That is what we will see. Coming to CDMO, a couple of quarters, if you look at quarter 1 and quarter 2, we are happy to share that we are now hitting a century in terms of revenue, 100 crores plus. And that aspiration for CDMO business with that partnership that we have with some of the big multinational players, to take this business contribution, which is today close to 12%, to around 20%. That is mid to long term. And this is backed up by some new developmental work that we are doing in the world of lozenges, where we are the third biggest manufacturer of medicated and non-medicated lozenges. We have all the capabilities, we have all the capacities to manufacture lozenges, and also good partners. And in addition to that, we are also looking at how to add more number of partners in this entire world of CDMO.
So from 12...
And equally talking about margins.
Yeah, go ahead.
From 12 to 20% in next 3 to 5 years, depending upon... So this business, Niger, has its own gestation period in terms of developmental work. Develop a product, you share with your partners, they do their own research, they come back to you. There are some changes which happen. Yes. So we are fortunate enough, by the way, to add Reckitt as a partner in last 6 months, in a time of 6 to 8 months.
Yes, Mr. Chopra, you were making... Yes, Mr. Chopra, you made that point. What about on margins? You were telling us about
good margins.
Yeah, go ahead.
Good margins as compared to where we stand, overall margins for the company. Better gross margins.
By how much, sir? If you could give us a rough number, how much better?
We don't specify margins of a business, but it's healthy margins. More than that is what I can share.
Okay. On the top line, right, you've done about 1,600 crores and it's been a very good first half for you. Over a 30% growth is what you've seen. On this base of 1,600 crores, what can the growth look like in the second half of the year?
So if you look at, Sonia, the run rate for India business, which is contributing around 50%, is now 400 crore plus. The run rate for CDMO business is 100 crore plus. So for second half of the year, we are looking at that we should be close. Quarter four for India business is somewhat soft because 50% of our business is acute part of the portfolio. But still, we should be good enough to score and touch a new peak this year of around 3,000 crore plus. That is what I can say at this moment of time.
And these acquisitions, I mean, you said, right, that you're scouting for something. You're, of course, not giving us any more details, but will it put more pressure on your debt? Your net debt is about 150 odd crores. What will the debt look like, say, 12 months hence? And will these acquisitions be in the range that you have earlier done? I mean, you've done about acquisitions between 250 to 600 crores. Is it in that range itself? Are you looking at larger acquisitions this time around?
It all will depend upon what is available on the table, and if we have the ability to turn around. We are more looking at opportunity from a perspective of string of pearls. That is what we have done. From a debt issue, I think we are rightly balanced. We'll be able to generate enough cash, which will help us in terms of looking at acquisitions, and we can also look at raising funds. So that is not an issue for us in terms of if we have the right opportunity in terms of what we want to acquire, depending upon what is available in the market.
All right. Mr. Chopra, thanks for joining in. But just want to clarify one point. You said the India business, the contribution goes from this 50% to?
60%. Short to mid-term, in next 2 years, you should see this happening.
Okay. All right. Good speaking to you. Thanks so much for stopping by and filling us in with all of those details, guys. Prashant.
All right, Nigel, thanks very much for that. Well, the market, by the way, the Nifty is down 40 points. So we're at the lowest point in the day. And this is, at least on the index, there is a little bit of pressure which is emerging. This is something we were alluding to earlier as well, that at highs, maybe there is some hesitation, which one is starting to see. And you can, I mean, look at the screen, look at the way prices have been moving for the last couple of days. It's been telling you that, but nothing large at all. Just on an 18,000 index, you got a 40-odd point cut so far. Vikas Jain is with us. He's India strategist at CLSA. He's joining us from the sidelines of the 25th annual CITIC CLSA India Forum. Vikas, great to have you with us here on the program. Thanks very much. You know, you've been, I think around Diwali, you came up with a note saying, play safe. So you've been advising caution for some time, Vikas. I think last time you were on the channel, on the program, you were talking about bond deals, the gap with earnings. How has that view evolved now, looking at where markets are at? Go on.
So we kind of turned a little more cautious around middle of August. That's roughly the time when Nifty had hit about 18,000. See, we've been in a period of extended valuation for some time. So in times like these, it's very tough to kind of really pick timing. So we have the help of our sentiment indicator, the India Bull Bear Index, that had got extended to almost a 90% bullish level by middle of August, around the time when Nifty had hit 18,000, right from the rally around 15,000 to 18,000. From then on, we also saw several events. I have to concede that the market has digested many of these events around the Fed, around OPEC, and many of these things rather well. And even the winter, to start with, the worry was that energy prices could start going up around winters. That's been a mild winter so far. So yes, and seasonally, we are getting into a better period for the market, at least over a month and a half or so. So, well, there could definitely be relief after having digested this. The next one is, of course, the December hike, where there is a lot of talk. However, that doesn't take away the overall macro concerns that we step in, with which we step into the next year. So for now, there could be a seasonal relief that we typically get around December, and and that's something which could help us. But going into next year, one needs to be cautious about the macro setup.
Okay, be cautious about the macro setup. By the way, perhaps on cue, the market is also turning a bit cautious now. The Nifty is down about 40 odd points. The Sensex is down 150 odd points. And just pull up the contribution plate. A bit of pressure on the index is coming courtesy the IT stocks. So TCS, HCL Tech, Tech Mahindra, Infosys are all down about 0.5 to 1%. Vikash, hi, good morning, and pleasure hosting you on the channel. Wanted to ask you about some of your overweight sectors. You're overweight on banks, real estate, and energy. Let's take it one by one. On banks, first up, what is the prognosis now? Because I also noticed that you've exited SBI and you've added a couple of other large caps. So do you think the run is done there? Do you stick with the private banks? What's the way forward?
So banks is a rather consensus overweight. That's not really something which is very different anymore. We've been overweight on banks for a while. If you look at the setup, we expect yields to kind of continue rising in that kind of a setup. These private banks could have NIM expansions. So that's something which we continue to play. We had reduced our overweight. The big change that we made when we, around that time when you speak about that note, was we've been underweight IT for a long time. That has turned into a very small overweight, neutral to overweight IT now. In our opinion, the big trade to play would be from here on, particularly in the last few weeks of the quarter of the year, we see a tendency for laggards to play catch up. And there are a lot of laggards that we have in our portfolio at this point of time. From that perspective, it's a rather anti-consensus portfolio that we run. And, IT could be one of them in general. And so from October onwards, IT has not done badly. If you think about this rally, and the rally, particularly over the last 1 month or so, has been largely led by the US. And US stocks have done well. And US was what was correcting over from the start of the year. So all of those sectors which broadly underperformed, particularly IT, would be the ones which should be doing well in a US-led rally that the market is seeing. So I think IT is not looking that bad as it used to us. The other out of consensus call that we have is that we're almost zero weight on consumption for more or less the similar reason. I think it's no more an India bottom-up rally. It's more a global rally now, if there is whatever is left of it. So I think on that, we are not comfortable in a rising yield environment with many of these frothy consumer stocks. So those are and other than that, energy, I think energy is one sector which is a bigger laggard. So when there is a laggard play, some of these energy stocks could start doing well. So that's really some of the names that we like.
Hi, Vikas. Good morning. Good to hear your thoughts. Vikas, what about the city gas distribution companies? There's been a newly appointed committee. They'll be deciding on the pricing out there. How do you approach this space?
So, wearing my oil and gas hat, essentially that new committee would be very important for the next move in energy stocks in general, whether it is the gas consuming stocks like city gas, or whether it is the producing stocks, that is the oil producers or the gas producers. Various commentary coming from media, from elsewhere, suggests that some kind of clarity on the report should come out in coming days. So that is clearly getting watched out for. Let's see what is the kind of gas prices that we get onto. But that could be a clear trigger. I do not, rule out a possibility that this could be a trigger both for upstream as well as city gas. Odd as it might sound, but upstream stocks are building in very low expectation. I think just the clarity coming in could lead to be a trigger for them. We prefer upstream the most amongst the micro sectors within energy. So I think this report could be pretty crucial.
Vikash, yeah, I mean, your point about being overweight, the big laggards is interesting. And one is starting to see that in the broader markets as well, right? I mean, stock specific, out of the blue, things which are down and out, forgotten, suddenly move up. We've been seeing that kind of price action for the last couple of weeks now. In terms of flows, Vikash, what are you seeing, and what are you hearing from foreigners? Because you've written in the past about that aspect as well. India within EMs and weights, etc. Where does all of that stand for you?
Sure. So I think that's something which got quite a lot of attention. I made a presentation yesterday at the conference. So I think keeping aside our cautious stance for the more near term, structurally, there are some changes which are definitely happening. Even now, almost about 95% of the flows that foreign flows that come into India are in the basket category. You can say that this is not really direct India flow. It's coming into a global benchmark or a global mutual fund or a Asia X or an EM mutual fund, and they are deciding the allocation into India. I think a couple of structural changes are happening. Number one, if you look at, we're getting into a little bit of a conflict in the world, very clearly a conflicting world as compared to the previous decade where it was much more peaceful. There are two broad power axes that we are talking about. If you look at it, India is perhaps the only large country which is okay with both of those power axes, maybe a non-aligned kind of country where both of the axes, both the Russia and the US, want to be, want to have India as a friend. That puts India in a reasonably strong position. Beyond that, given the problem that the largest EM market is having, I think there's clearly a favor that India is getting from flows. We've seen certain large pension funds bring down their weight in China, saying that they'd be using half weight of the benchmark, using the discretion to reduce the benchmark weight. Some of those challenges kind of make India far more attractive. And lastly, if I were to look at the depth of the Indian market, simply taking one simple data point that the number of billion-dollar plus market cap stocks in India, we are the fourth largest market in the world. That's after China, Japan, and the US. We are the fourth largest market. All of these three markets are not basket cases. There are flows that directly flow into these markets. I think soon, in a matter of 3 to 5 years, we see India also getting that, is what my opinion is.
Okay, all right. We will leave it at that. Vikash, thanks a lot for joining in and giving us your view on the market and on the way forward. That's Fusion Microfinance. The listing is a bit on the weaker side, 3.5% lower now. So that's a slightly weak listing. It's compared to peers, it's actually a bit of an expensive issue, and perhaps that's the reason why the stock is under a bit of pressure. The valuations are trading at about 1.76 times price to book. And it has a huge penetration. It's a well-diversified business, but there are some weaknesses in terms of return ratios are on the lower side. In fact, for the last many quarters, there's been no meaningful return ratios for the company. It has a lower credit rating as well. So slightly expensive and weak fundamentals is something that's perhaps dragging the first stick on Fusion Microfinance. So it's a weak, subdued listing over there. Let's slip into a quick break. On the other side, we'll get you a quick update on what's happening in the markets. Mitesh Thakkar will join in.
Welcome back. Well, from the Nifty itself, I think Reliance Industries had slipped lower, and that's why, we are back below that 18,300 odd mark. So just keep an eye out on that big boy. It started off in the green, slipped a little bit, and that explains why we've dipped into the red. Mitesh Thakkar is back with us. Mitesh, well, par for the course. We've pulled back 30-40 points odd after the kind of rally that you say. I think we pulled back a couple of 100 points as well. The uptrend will stay intact. But what's your take on the index as well as individual stocks?
That's right, Nigel. I think, that consolidation which started yesterday, I think still remains. And I think even a pullback to about 18,200 would not be, any damaging to the uptrend. Only, in fact, if we break 18,120, 125, that's the time when you'll be worried. But for the time being, cement stocks look very good to me. Ultratech and ACC are on the buy list. ACC can be bought with a stop at about 24.50 for targets of 25.60. While Ultratech, if you look at the levels, that's a buy with a stop below levels of 68.70 for targets of around 7,100.
Okay, thanks Mitesh for that. Well, let's move on now to the commodity markets. Manisha Gupta is joining in. Manisha, what's the one commodity you're looking at today?
Sonia, I'm looking at the crude oil prices and they really seem to be getting stuck in a range now. We haven't seen a breach of 90 on the lower side or 100 on the higher side for that matter. It really has been trading within that $91 to $98 per barrel mark. The overnight markets have seen a 3% of a decline in crude oil prices, and this is after the OPEC monthly demand report came in yesterday, which says that they are looking at 2.5 million barrels of a demand growth in this current year, and this is the fifth straight month where they have actually cut down on demand growth estimates there. This is the OPEC output output, or what we have seen in the last couple of quarters there, the first quarter OPEC says there was a deficit in the global markets by real little there. But then second quarter and third quarter have seen a surplus, and they are anticipating a surplus in crude oil in sense of supply in the fourth quarter as well, and is the reason they are talking about further output cuts. For the month of October, the OPEC output was 2.1 million barrels per day, less than the agreed quota. They have decided to cut 2 million barrels per day of quota from the month of November itself. That is something that they already have in sense of cuts. So it would be important and interesting to see on what kind of output cuts we actually see for the month of November there. OPEC also has said that it is about high inflation, rising interest rates, chain disruptions, and of course, rising COVID cases in China that have continued to weigh on to the crude demand there. Even as China has taken back some of the restrictions that they put out on COVID, but the fact being that the COVID numbers in China have continued to be near record highs. All the economic data that we have seen coming from China has continued to see a decline, including the GDP at 3.9%, while the official target of China is 5.5%. All the data that came in today as well, whether it has been about retail sales, factory output, all of those numbers also show a slowdown, is the reason that many of the commodities which actually open on a firmer note in Asia today have now seen a profit taking coming into the markets. The expectation is that you could be looking at weaker demand, not just from Europe and US, but Japan as well, where as well we have seen the third quarter GDP shrink by 0.3%. Markets were anticipating an increase of 0.3%. So this is quite a surprise decline as well. So everywhere that you look, weak economic data and concerns about demand is what is weighing on to crude prices.
All right, Manisha, thanks very much for that. Commodities in focus. Look at Nykaa. I mean, if we will put the stock up, 201 is down 5%. Nykaa had a decent move last couple of days, but all of that is now seeing a bit of reversal at this point. But it's not just Nykaa, lots of names. We pointed out Info Edge, and this is reversals from yesterday, just yesterday. Action Construction, that is ACE, hit a new high yesterday. It's down 4%. And I can spot so many others which are seeing similar things. DCX India, which is the recent listing, that is down about 4% as well. So 288 on that one in the broader market. Uflex is down about 5%. So these are well-traded stocks in the broader space, which are seeing some corrections. IRCTC is another one. Mangalam is here to detail it out once again for us. Mangalam.
Well, IRCTC is understandably lower, primarily on account of numbers which are no great shakes. If you just take a look at the numbers, quarter on quarter, there was a 5% dip in the revenue as well as the EBITDA, as a result of which the net profit dipped by around 8%. Yes, there was growth year on year, a 90% jump, 99% jump in their revenues. But, there was a sharp contraction in the margins year on year as well, which is why the EBITDA grew just by around 44% and the net profit by about 43% as well. Why is that? Because year on year growth was led by businesses which were just partially open the same time last year. Catering, for instance, a 370% jump year on year is what we saw in the catering business revenue, and that came with its increase in expenses as well. Catering is a relatively lower margin business for the company, so catering expense from 28 crores jumped all the way up to 235 odd crores. The business which actually is the margin driver for the company, which is ticketing, has remained stable both year on year and has not seen a big growth year on year either. Quarter on quarter it's flat, whereas year on year it's just a 13% sort of growth. The other business which led growth this time around on the top line was Rail Neer, which is the water business, which saw a 75% growth in the revenue. But here again, it's a 7.5–8% margin business. So which basically means that the businesses that grew for the company this time around year on year were primarily on a low base and low margin businesses, while the margin driver for the company remained stable quarter on quarter and just a mild growth year on year. The street does not like that.
Talking like a fast train there. Thanks, Mangalam, for that. Down about 2.5%. But let's go across to Vivek now. He's going to track GMR airports for us. Vivek.
Well, that's right. So moving on to the airport space now, when what's actually happened is that it's a seasonally weak quarter as far as GMR airport infra is concerned, basically impacted by higher fares. While traffic growth has improved, on a year-on-year basis, it's still not closer to the pre-COVID levels, and that is something that markets aren't liking at this point of time. So when you're talking about the overall results, what's actually happened is that while traffic growth improved on a year-on-year basis, margins actually have dipped significantly, and also on the back of a couple of announcements that the company has made in terms of the gross revenue and the net revenue, this is also something that the street is looking at very closely. So looking at the numbers, while gross revenues have jumped up almost 54%, net revenues have gone up only 17.5%. This is on the back of the fact that the company now has to share revenues. This is from April 2022 with Airport Authority of India. This is for the Delhi airport that they operate. Reported EBITDA is down almost 5% on a year-on-year basis, and margins at 42 versus 52% on a year-on-year basis. Losses have narrowed, but still it's a loss on the bottom line, almost 210 crores worth of loss. So what the company is saying is that going forward, they expect momentum to resume with the addition of newer routes and airline capacity. Also, what they're saying is that in terms of the key highlights, Delhi traffic as well as Hyderabad traffic have jumped up almost 75% each. So that's some positivity as far as the passenger growth is concerned. Also, they are looking to divest stake as far as the Philippines airport, and that would lead to deleveraging on the balance sheet.
All right. Thanks very much, Vivek. Appreciate you joining in with that. The market's absolutely flat, so no great shakes at all in either direction. We'll take a break here. On the other side, our special segment, it's the economy. Lata will discuss key macro numbers with Abhishek Upadhyay of ICICI Securities Primary Dealership, Mridul Sagar, former Monetary Policy Committee member. So that conversation on inflation and other macros coming up in just a bit.